Good deal. We are live. Real Fridays with Rock Cassidy, and Jeremy Potter. We are live every Friday at 12:30 for Real Fridays, where we talk about mortgage, housing, and real estate, and we focus on real issues, right? Real issues that impact consumers, vendors, technology companies, mortgage lenders alike. And it's interesting, Brock. A number of I've heard a pretty steady stream of investment banks that watch our show just to get better understanding of what's happening in the market and who are the players and what are the trends and what our perspective is of it from as an industry insider perspective. So I think that's a pretty encouraging barometer that I think we're touching
Yeah.
upon the right things.
Yeah. Are those from like expert network type things or
Yeah.
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 I've been seeing a ton of those too. And I think Potter does that as well. A lot of what do you think about XYZ merger or et cetera? Yeah.
Yeah.
That's interesting.
But they specifically cite our show as something that they watch that they find interesting. You know that?
Yeah, I did not know that. And I'm
Yeah.
not sure I believe that, but I like it.
Yeah. Yeah. Well, no, it's totally believable because they're actually telling me. But you should bring it up, even in those conversations you have with VCs or other private equity groups. You should bring it up and talk about Real Fridays, because they. I bet you'll be surprised how many actually acknowledge their how they kind of track these types of things. I would say, what would you say to be the highlights of the week in your view?
Well, I just got back. I ended up having my flight delayed, so that was not the highlight. But I was out traveling to launch a new partner this week, so got back early this morning to New York.
Can you disclose who?
Yeah, it's we'll go through the proper channels, but all the marketing's live and sales is live. So yeah, Sage Home Loans.
Oh, fantastic.
Yeah, Red Ventures, Bankrate's sister company. They're growing a really, really great DTC operation really quickly. Bunch of ex-Rocket people, ex-NewRes people. So it's we're partnered pretty early. Really excited about it for a lot of reasons.
I think that's great, man. It's just so interesting how the pendulum swings in the market, because it wasn't too long ago. I mean, it must have been pre-COVID, where these call centers were not only all losing money, but they were selling and being absorbed, and or just being closed down because of the fact that the cost of conversion was just so high, and most of these organizations were losing money. And now I'm hearing like the emergence of really two things. One is the call center, and two is the wholesale lender. The number of wholesale lenders that are just popping up, even in your old neck of the woods. I almost think that the not new, but kind of the Silicon Valley for mortgage, when it comes to around the country, like North Carolina's furniture, Connecticut's insurance. Like there's different pockets around the country that specializes in certain industries, and I can't believe the number of mortgage companies that are in Detroit that are like just operate in and around Rocket and UWM.
It's hard to explain. Anyone you meet from Detroit knows 10 people in the mortgage industry at FUS.
I mean, it's really incredible the number of people who
we're talking about the next belt, Potter. Good timing.
It is. It's where you want to be.
It's just the number of mortgage companies. There's so many people that are doing mortgages in high school, and they start in high school, and then they either skip college or they're doing mortgages while they're in college. But I can't.
I mean, I give Rocket a lot of credit. I don't know. I've never been really inside UWM too far. You guys may have, but Rocket just trained thousands of loan officers, got them certification, had I think it went by a few different names. Potter, maybe you remember, but the foundation where you could have a junior loan officer job while you're getting your certifications or things like. They just created a pipeline of thousands and thousands and thousands of loan officers that went all kinds of places, started their own brokerages, all kinds of things. And also, they're almost all in Detroit. Over time, there started to be more at the Arizona site, the Cleveland site, the Charlotte site, or North Carolina site. But I mean, it was heavy Detroit. And I think now we're 10 years after that, 12 years after that, and they're dispersed a little.
Well, and also went into other roles throughout the company. Like how many processors, underwriters, closers do we know that started as a banker?
Real estate agents, tons. Yeah.
So it was, I bet you if you added it up over all the years, all the iterations of the company from Rock Financial to Quicken Loans to Rocket Mortgage, I bet it was 30,000 people, honestly.
Yeah. And how many of them were in Detroit? 25?
28, yeah, 25,000 probably.
Yeah. So I honestly think that's a huge portion of the reason, Rick, especially today, because that was between like, I'm sure there were various versions of it, but when I saw it from, mid 2010s, it was hundreds of new folks every week going through that.
Yeah.
Crazy. You're muted, doctor.
He's talking. You can see him talking.
It's no question. It's ground zero for the mortgage industry. I mean, pre-crash back in 08, prior to 08, like Orange County, like Irvine, California was Irving, California was really was really the ground zero for the mortgage industry. And now it's really remarkable the concentration of companies of, the sheer number of mortgage companies per state, and also the number of mortgage companies per capita per state, to see where that is, because it's what Silicon Valley is to technology, Detroit really is to the mortgage business. And it's really fascinating to see.
I guess we know why he was muted now.
Yeah. Go back on mute, Rick. Yeah, you're very robotic.
Where is he?
I like what he's saying.
I like what he's saying. I muted him. Where he's where are you going? Where are you?
We basically can't hear you at all, nor can our listeners.
How is it? How is it now?
0 out of 10.
Pretty choppy.
Is it any better?
2 out of 10.
Yeah, 2 out of 10. But
Potter going through.
How disappointing! I was making such a good.
You did make a good point.
All right, let's go back on mute, and we'll keep going from that point. So, something that I think is even more interesting in probably every industry, but definitely this industry, is that then there's the sub pockets of it, where there's, like the, all like the house flipping industry in California, and maybe some more of the Sun Belt, all the construction and in Florida and Texas. But what really is remarkable to me is I keep finding out about these new sub pockets as I am doing partnerships for a company that all we do is partner with mortgage companies, like the Kansas City Mafia, right? Are you guys familiar with that term? It's like all these direct to consumer mortgage shops in Kansas City that have continued to spin off. And then, in Charlotte, that's where I was this week, right? We continue to sign more partners in Charlotte who are in the direct to consumer, generally direct to consumer, some other like regional purchase focused lenders as well that we work with. But it's, I find myself traveling to the same places over and over for all different partners, because these sub pockets do build.
Yeah, I think I used to write that Saturday Cup of Joe just about kind of things going on. And I think that I was pretty wrong. I'll have to go back and look just for fun. But I think I was pretty wrong about the need to work with people in an office. I still don't feel that need that strongly, as you can see from being in a home office in Detroit all the time and running my business out of it. But the reality is what Brock just said, is the mortgage industry is still largely, 80%, 85%. We want you in some central location or nearish one for a pretty significant period of time. And it's just been surprising to me. I don't know if there's a relationship between that and the ability to change and change management and innovation, but there is certainly a more defiant resistance to remote and to digital than I had anticipated. I don't
know if I agree with that, Jeremy. Like, why are you saying? How are you defining remote versus like a defiant resistance to it? Because when I look at the top 100 lenders, they're all distributed. I mean, for the most part, taking the depositories out, they're all distributed retail lenders. They're all people who have, who are just dispersed all across the United States.
They all have a hardcore HQ.
Do they all have?
Everyone I can think of still has a hardcore HQ in one of those cities.
Yeah, but
they have sales and ops working from home or working wherever they want, or do they have?
Well, more sales, but 60% of these, maybe
Distributed
greater than 50% of these companies are employees who are sales LOAs, sales support, and loan officers, and they might operate out of branches.
That's what I mean. No, that's what I mean. Do you go somewhere other than your house for work?
So you're counting a branch office with 5 people. You're not just counting the headquarters. Yeah.
I agree with your point. Yeah.
Yeah, I'm just surprised. I would have thought that there was a high degree of we will recruit talent nationwide, and if you're not near something, just work out of your house. And that is not the approach, is kind of what I'm saying. So like Rick, you were talking about a nexus of talent in Detroit. Brock was mentioning there's a couple other places, Charlotte and Kansas City, that would have their specialties. We know Dallas is a servicing hub, and Fannie, and obviously Orange County. And it doesn't sound to me like there's some examples of recruiting out of Detroit and letting them work out of Detroit, but I think there's a lot more examples of like we're going to have you in an office, even if it's a 5-person office, a couple days a week. I'm just surprised by that. That's all.
Yeah. No, I mean, it's interesting. I mean, there's that reality, and then there's the contrast with, all of these emerging. I think with the emergence of wholesale, I think that's going to move that needle, because you get companies like Nexa, who's got 8,000 loan officers who are largely all remote, or maybe working out of a Regis or being tethered to a Regis for licensing purposes. But that's the other piece that's sort of dragged, I think,
That's true.
The in-office versus work remotely kind of reality is the brick and mortar requirements in about maybe a dozen states or so. But and so but I do think with the emergence of wholesale, it's going to have an impact on the regulatory framework that we operate within, and the technology framework and the technology needs of the industry. And I'm curious as to what you guys think on how that's going to move the needle. Will that move the needle with tech, or do you think it'll just shift tech in a different direction?
Yeah, I'm actually a little surprised to hear you say the emergence of wholesale in terms of like, I guess it's a bigger, I just assumed it was here when UWM won. And what I mean by that is when UWM went all in on wholesale and it got bigger, the company and the channel. And then when Rocket said, we have to do this too, to me, that is like, that was wholesale kind of winning.
So let me, you got to remember, I mean, wholesale is still only 24% of all loans. So wholesale to us on the retail side, and on the retail side, we make up 62, 63, 64% of all loans. Wholesale is kind of irrelevant to us, right? But where I will say, now I'm saying historically, it's kind of irrelevant to us.
Yeah.
What I would say is that it's becoming relevant, right? All of a sudden, I'm encountering more retail lenders. Supreme acquiring Michigan Mutual in the last couple of weeks is a good example of this, where you have a retail lender acquiring a wholesale platform, small retail, but mostly wholesale, specifically to get into wholesale. And more retail platforms. And I mean, Fairway got rid of their retail platform, or their wholesale platform 3-4 years ago. Because it was not, they couldn't afford it, right? It wasn't cost effective. So this pendulum is swinging where I think we're entering in a decade of the emergence of wholesale. And to me, wholesale is not really relevant until you start getting it closer to 40%, 35 to 40%. That's where it really is going to be an existential threat, I think, to the mid-market IMB. The IMBs, and there's only about 250 of them or so, but the IMBs that have servicing, fine, right? They have a diversification of their income. But the IMBs that are small to mid-size that don't have servicing, I think are going to feel the pressure, the competitive pressures led by really innovative tech by UWM, and just a business model that is just a lot lighter cost-wise, and that's going to account for just better comp for loan officers and just better rates for the consumer. So and I think that's going to squeeze out the mid market IMB.
And I guess what you're saying is you don't think that the mid-market IMB has felt that pressure from wholesale yet. The pressure they've been feeling is from other larger IMBs in the retail space, and now it's going to be both. Is kind of what you're saying.
I think it's been both, but it's been much more. It's been much more the economies of scale of the larger IMB. I think now that we're entering in this phase of like you now that we're entering this phase of the growth of the more of the expansion of wholesale in the last 2 years, and then I'm looking at Matt Ishbia's forecast. He wants to double his production volume in the next 3 years. He's doing 18 billion a month. Can you imagine tripling your volume or doubling your volume in 3 years? And he's not going to get that from stealing rocket brokers. He's going to get that from taking retail LOs, and it's going to be from the small to mid market retail mortgage companies. It'll be a lot harder to pull those people from cross country or New American Funding or NFM or what have you.
I can't imagine looking across this landscape and making that bet. I can imagine saying like, oh, I'll do that volume, and here's why. Like I can see the basis for why he would make that claim for sure.
Right.
I guess you're having me think a little bit differently about the way technology will be delivered, honestly. Because what you just described is a real threat to the large kind of providers like ICE and other big technology platforms like Total Expert. Because if you are able to just give tools out to any size originator, whether it's 8,000 brokers or 2, and they all have access to the same toolkit and products, why wouldn't you just go with UWM? Like, why? Yeah, I think that's fascinating to think about.
It's
Bill
think
Dallas,
about the costs. Think of the cost, the back end costs, and the technology costs that the IMB shoulders that UWM is just giving away.
right? Yeah. But Bill Dallas was on Robbie Crispin's podcast a little while ago, maybe Monday. I forget when it was. Maybe it was even last week at this point. But the description that he had of technology and of the threat of the wholesale originator to the traditional IMB was kind of exactly what you're saying. Yeah. So that's really interesting. Now, did you form any of those opinions differently this week, being down at EPM? Is that part of this?
No, it was just it was just more confirmation of it. The energy behind the broker channel is really on the rise, and I'm really sampling. I talked to more people who've left like movement companies who've left. I don't want to say movement because I have found them to be a bit destabilized over the last couple of years. They sold a bunch of their servicing in 2023, and they just it seems like they're always either trying to raise capital or always trying to sort of get cash together because of their high costs associated with just losing money. And so I ran across a couple of loan officers that had left movement and they love the broker channel, or even these non-delegated correspondent sort of platforms. And but I don't perceive like at NFM we don't lose anybody to the broker channel. Cross country, very few. Like I just don't think it's what I'm perceiving is the lenders that are the most susceptible of losing loan officers to the broker channel are the ones who are the most price compressed, and the ones who are the most price compressed are the ones who don't have economies of scale or servicing. And those are almost all. I mean, there's about 700 lenders that I've identified between 200 million and maybe 700 million a year in the United States that I think are the most vulnerable to this kind of attrition and hemorrhage over to the wholesale channel or some other alternative platform.
Can you be specific? Because I've often wondered this. When you say price compressed, what does that really mean to the homeowner? Are we talking about 20 basis points, 50, 100? like, what's the actual difference if I put it, and let's say we were even able to be intellectually honest and
Probably
to each other?
probably
What are we really talking about? What's the difference?
probably 80 to 120, 140 basis points, like that's delivered to the consumer. I mean, it's pretty substantial.
So that's a half a point. That's what, a half in rate? That's potentially?
Yeah, half to three quarters. Yeah.
Yeah, half to three quarters. Yeah.
Yeah. So I would say it's pretty substantial. And I think with AI, it's only going to get more compressed. And I think potentially either the margins are gonna hold the same to the lender, or they're going to price compete with greater latitude or greater flexibility because of the efficiency that AI is inevitably going to deliver. The big subject, the big topic at the EPM conference, and Eddie did an amazing job. I mean, he had 1,000 or so brokers there, and it was really, the message was adjusting to the change, like understanding that AI is here. And one of the speakers spoke about how AI is very much going to shoulder more and more of the originator's role and responsibility. And when changes inevitably occur within the SAFE Act around licensing and how that's going to end up being, how that's going to impact AI and the activities that AI perform that are often going to be associated to originating activities, that it's one quote was they wouldn't be surprised if 30 plus % of originators don't have a job within 2 to 3 years. I actually think it potentially could be greater than that. But that's
how many have lost their jobs if you did that stat over the last 2 to 3 years? 30%, 40?
Oh, more than that. I mean, just
right.
from the market.
So I mean, that's like that's already. I guess my point is that's already the pace we're on, right? That's already the curve we're on. That's not even a leap, unfortunately, for people in that position.
Well, yeah, I mean,
I think it's 2022. There was 230,000 licensed loan officers in the business, or something to that number, and now we're looking at 111,000 licensed that have done at least one loan or more in the last 12 months. Maybe it's 118,000, but
yeah,
you can't live on doing one
year.
loan a month.
Yeah.
So if you look at the number of loan officers that do like 3 or 4 units a month and up, now all of a sudden you're talking about 65,000 loan officers to 70,000. So it's like, I think it's the future could very well be a market where we have maybe anywhere from 40 to 50,000 LOs, and the rest just go away because of these efficiencies that either shoulder the volume itself or the efficiencies that drive the volume to the top producing LOs that remain in the business.
Yeah, that last point I think is the point that I'm most bullish on, which is I've heard too often about consolidation where companies or brands go away, and I don't believe in that anymore. If I ever did, I believe it more to be consolidation within the company itself. In other words, that kind of old GE model of, eliminating the bottom 10% every year, except for us, it's going to be like you said, Rick, a short time period where a third of the bottom producers, and honestly, some of those bottom producers are probably actually sales leaders just doing a loan here and there in between leading a region or leading a group. And what we will see is the big producers who are using the tools are going to get bigger, and we will have fewer by license, but it won't really tell a volume story because all those loans are just going to flow up the food chain at every single company. And so you'll just be feeding your biggest teams and feeding your biggest producers, and that's who's going to win in this moment, I think.
Yeah. So the question is, what does that mean for technology? Does that accelerate the pace of technology? Because brokers are pretty unruly. It's an unruly demographic. It's an aggressive demographic. It's a high sales, high intensity demographic.
Yeah.
I think sorry, Brock, go ahead.
I was going to say, my first exposure to this in a while, when I was at Easy Knock, my last company, you guys both know, but for anyone that doesn't, we signed a lot of brokers up. It fit well within like the independent brokers, adding another tool to the toolkit for a specialty product at the time, right? But I really haven't spent as much time in the broker channel as of late, with one exception. We recently signed Nexa, and not like we got all 6,000 day one or anything, but we on a kind of a rolling basis, we're signing up some new Nexa teams loan officers. And one thing I think they do that's really smart that I've seen from still the outside, but getting a little closer to the inside, there is that they give loan officers kind of like a store, where you get X amount of credits per month to spend on tech or leads or anything that you need as a broker. And then they have like approved solutions for it. Potentially that's where NewZip will end up. So I wonder how things like that are going to work. Where is it going to be like, sort of like, and companies like Fairway basically do the same thing in the IMB world, where they sort of like say a solution's approved, but don't push it on people. I wonder if that's where it'll go with brokers, of tech that's integrated and ready to go, but brokers can at their own personal level choose to like turn on or turn off. That's a lot of what we think will happen when like I talk to my product team at NewZip, but curious what you guys think.
I just think we haven't seen somebody get really smart about the interoperability of all of that with everything else. And I'm not dangerous enough on that type of technology to weigh in, but like what you just described is kind of like an ideal state, but feels somewhat unrealistic to me, because we've not proven that we can operate the train station in any kind of real way in this industry where you can kind of mix and match that way within the same environment. I think what we've proven in this industry is that if a big provider is going to give me something that I can use, even if I don't love it, I'll find a way to use it if I want the other benefits type of thing. So I think like the fork in the road that you're describing is like, if UWM sets up an ecosystem and I can just plug in and run, why do I need to pick my commodity product? Why do I, like, I'll give you an example. I've heard a few people pretend that voice AI is a differentiator, and almost everybody I talk to in the tech world's like, it's a commodity. You can pick your provider, but one voice AI provider for sales outreach, inbound or outbound, is not anything
that there's 10,000 companies doing the same thing for.
Well, we have 1.6.
It's really cool. It's really cool tech. It's really new tech, but there's 10,000 companies selling it. Yeah.
It's like our lag is 0.3 seconds versus 0.2 seconds. It's like, okay, whatever. Like, so I think it'll be more, I think it'll actually get a little more boring, to be honest, because the keys to the tech are going to be managed by whoever owns the scale. If UWM owns the scale, they're going to manage the tech. If Rocket owns scale, they're going to manage the tech. And also, I think it's going to be harder and harder to get your little niche tech product into one of these walled gardens, So I just think it's going to be.
I guess that's the part two of what I was saying. A massive part of what I am betting on in my kind of strategic fit in the industry for NewZip is, and for our whole product team and our whole business, is getting in the walled gardens, and adding enough value to earn a place in them, right? Because most of them are not looking to add 3 companies in this space or 10 companies in a space. They're looking to add 1. And so, but we'll see.
Well, I think you hit the nail on the head with the description of what it will do to technology, right? Because I think when you have these greater barriers to entry or to adoption for new technologies, UWM is a very difficult company to introduce a platform, because they tend to want to create their own. Probably not all that dissimilar to Rocket, I assume. And of course, the ones that they do have are going to be much more difficult to replace. But yeah, no, I mean, it's the technology landscape, I think, is going to consolidate as well. I mean, I think it almost has to, because when you have lenders, highly capitalized lenders, that end up consolidating or integrating the tech into their experience, the loan officer experience, the consumer experience. It's not like you can easily, to Jeremy's point, it's not interoperable with other solutions. You're going to be pretty married to that platform,
Right.
either built in-house or partnered. So I don't necessarily know exactly how that's really going to be beneficial to companies.
And I guess I wonder if, like, again, I'm not that experienced in the wholesale world. Is the thought that wholesale lender, I hear Rocket and UWM's talking points, right? That's my experience. They're trying to give away more and more tech, more and more value. And then, I'm sure other competitors are as well, but I feel like other competitors are more focused on just having the products and the rates, right? So I do wonder too, like I just gave the Nexa example. They're the biggest or second biggest. I think they're the biggest broker.
Yeah, they're the largest one. Yeah.
Yeah. The largest broker in the country. So like, I do wonder too, of like who are we going to as an LO, as a independent mortgage broker, as the owner of a mortgage company, like who are you okay with owning the tech? Would you rather, is UWM or Rocket owning it all and you being a user under them? Okay. If you're another, or do you want to take the Nexa approach? I was laying out what I've seen from a way zoomed out view of trying to create your own store and your own integrations and your own view. So I think that'll be really tricky. But I'm really not that experienced in the wholesale world, so that world's still a little fuzzy for me.
I would go ahead.
No, I was just wondering, Rick, if I could frame Brock's question this way, because I have a similar. Are mortgage broker companies in a position where they are even able to control that decision? Like,
do they have to pick?
The brokers themselves cannot.
Because the alternative is too expensive. In other words, like, what's the point of being a broker if I have to buy everything and control everything myself, right? Exactly. Because at that point, I might as well just be a lender. It's like I'm just going into the business knowing I can't control it. That's part of being a mortgage broker. Is like, I'm going to offload that cost, and by its nature, I'm not going to be able to pick it then because I've offloaded the cost, unless somebody delivers me this very flexible toolkit, which we have not seen, right? So mortgage is too expensive.
I agree with that. It's mortgage. It's a mortgage experience in a box. That's why you become a broker, so that you can focus on sales and all other services are delivered to you by the wholesale lender that you're partnered with. Because otherwise it becomes very difficult to manage. Now, I think UWM's model is pretty fascinating, and it's very retail-like, right? You join a company like NFM because we've built out the back office. We have the technology, we have the CRM, we have all these tools that we're delivering to the LOs, so the LOs can just basically sell, right? Well, UWM is now delivering all those solutions. You can use UWM CRM. You can, in fact, if you use UWM, you don't pay for credit pulls. They have a whole department just for appraisals, right. and the borrower gets charged $0 on an appraisal that's ordered by UWM if it was used. Now, I'm sure they're just bearing that into their costs, but as a broker, I'm able to say this is an integrated all-in-one kind of experience, and as a broker, I'm not having to pay for the credit pulls, which is a lot given the whole FICO stuff, and then just the increase. What's the matter?
No, I said this industry and FICO's cracks.
Yeah, I can't avoid the FICO call outs. I like
yeah.
So I think it's just a question of trying to figure out, because I see the top tier IMBs, and this is why I encourage you, Brock, to get to know the broker channel more and more. Because I'm being challenged to do so myself, because I haven't really operated in that space in 15 years. Right. But I would say that the top tier IMBs are going to benefit from these market adjustments, and I think you're going to see those organizations grow larger, and then you're going to see the wholesale space grow larger, and the mid tier IMB is going to either be absorbed up into the IMBs, or going to be assimilated into the broker community as either non-delegated correspondent partners or just straight up brokers.
And for
Brock, do you know what I mean by non-delegated correspondent? Just for, because you may not know, but the audience may not know either. So non-delegated correspondent would be like Jeremy has a broker shop, and he gets big enough where he gets a warehouse line, right? Well, he doesn't have his FHA, so he can't underwrite. He can underwrite conventional if he wants to hire an underwriter, but he can't underwrite FHA. So he would partner with a company like UWM or Village Capital or someone, and they would do the underwriting for that for Potter Mortgage, and close the loan in Potter Mortgage's name. But because they underwrote it, they then would buy it off your line, off of your warehouse line. So it's a huge advantage. So if I looked at Potter Mortgage's numbers, I would see there's all these loans being closed in Potter Mortgage's name, which is a hallmark sign of what a mortgage lender does. Disclosures are being sent out in Potter Mortgage's name. But he's assigning the risk and the authority over to like a UWM or a Village or whomever, to underwrite it, close it, and fund it in Potter Mortgage's name. Now he gives up margin to do so, but he also doesn't have the risk, right? That also is expensive, you know. So it's a way that you can escape the broker-related margin caps, because you're capped at like 275 as a mortgage broker by Dodd-Frank, so you're able to close loans in your own name and bank loans, and make probably an extra 50 basis points or probably 50 to 75 basis points above what a typical broker would make. But you're using a UWM to do that. So UWM is building their servicing portfolio, or Rocket or Village or any of these, you know. So
you're getting even more integrated in their ecosystem as a trade-off. I think
yeah,
that's what you're saying in that
absolutely
as well that you were showing.
I mean, the only two things you can control are sales and marketing and operational costs, delivery costs. So I like to call it like origination or operations costs, but in Rick's framing of it, it's delivery costs.
Yeah.
So if I control what I can control, no matter if I'm an IMB or wholesale, it doesn't make any difference. It's sales and marketing. That's one bucket. And it's delivery costs. That's the second bucket. That's it. That's what I am. That's my business. So I do like that framing, Rick, because I think if everybody thinks about it that way, it's just a matter of, all right, how much do I spend per lead? And how do I get my delivery costs as low as possible? And those are my two levers, no matter if I'm UWM or if I'm, Potter Mortgage.
But I would say for both of you guys, I would say there's probably about 50 mortgage companies that really function like independent mortgage banks, but they're just retail front ends of Rocket or UWM.
Right.
Would be companies I would target. Now, the industry calls these companies brokers, but they're not brokers. Like Nexa is not a broker. They say they're the largest broker in the country. They bank 80% of their loans. Now they're not. They have no underwriters on staff. UWM underwrites a lot of those loans, and other non-delegated correspondent underwrites those loans. But they're a mortgage bank. There's no questions about it. But their costs are lighter.
Yeah. You know what's funny about that, Rick?
Which makes it more price competitive.
I totally agree with you. What's funny about that, though, is when you talk to people like Wall Street guys, they call Rocket and UWM a broker because they don't see them as the ultimate, right? You know what I mean? Like when you think upstream capital markets, everybody's a broker in their mind because this thing has to go
selling off 98% of the.
Yeah, this has to go from Main Street to RMBS. And so the only person they really hold accountable is whoever put it in the RMBS. Everyone else before that is essentially a broker to them, even though we're making these distinctions about IMB. We're making these distinctions about being a correspondent or this type of lender versus a broker. But the reality is like the whole thing is a middleman to get to the RMBS. If you look at it that way, you're
100% right. That's why industry statistics are really difficult unless you know what you're looking for and how to ask the right questions. Most people quote statistics or market trends incorrectly. Even when they say like, oh, the broker community's, 30% market share. It's not. It's about 22, 23% market share. The problem is there are a lot of these mortgage companies that are kind of hybrid mortgage banks, mortgage brokers that are really mortgage banks. And so if you don't define your categories really specifically, and a lot of people don't understand them enough to do that, their whole analysis is skewed.
Well,
Their
even
whole
what you
analysis is
said
wrong.
even what you said about retail versus wholesale being a threat, we didn't break down retail between call center and distributed.
That's
So
right.
if you broke it down even further, wholesale and consumer direct might actually be neck and neck for volume. I don't know. In terms of that 20%, 25%, 30% type of analysis. So it goes, yes to what you were saying about complexity.
That's really fascinating.
Well,
So there
there
are
we have
dramatic. I do think there are dramatic implications on technology. I think we're going to see a lot of vendor consolidation. I think we're going to see a lot of deconsolidation. I think we're going to see a growth and in the
Oh,
enforcement. Next actually is just Jeremy, or is it picking up?
He's got to.
Can you hear me?
We were close to getting through that, but we didn't.
we heard something about Nexa, and that was it.
That was the only word I could make out in the last.
No, so
5
Nexa just joined Lenders One, which is a lender cooperative.
Yeah.
So all I'm saying is,
Can I
like,
ask this question if you know the answer? Can I ask this question if you know the answer? Why? To do what?
Well, because they're a lender, and Lenders One is a good organization because they're a co-op. So what they do like
But
they
to
started
do-
it.
this is what-
Rick's talking in the book.
This is what I'm saying,
What
though.
are they looking to get out of it? Not as Lenders One good.
Yeah, like to do what? Because if I'm getting all of my, we just went through the process of explaining why they're smart for getting all of their
For not having
technology.
to do all the stuff that.
Why would you join an organization that is going to get you technology you don't need?
Because this is where it's an ebb and a flow. Because when you're small, you need the economies of scale of a UWM, right? But as you get larger, you begin to create your own economies of scale.
You think they can get a better price? You think they might be able to get, with 8,000 loan officers or whatever you said, they might get a better price on their own now than they could from UWM for different vendor services. Basically, that's the only thing I can see.
It wouldn't be. But price is not the only consideration. One is just control of the price, where you can, where you are potentially, you're able to sort of reduce your price as needed just to win a deal, whereas you may not have that control working with like a totally like outsourced environment which controls that price. Does that make sense?
A little bit. You're saying that if I am a dedicated wholesale broker, I am bound by 1 or 2 rate sheets. UWM Rocket, maybe I have a third, whatever.
Yeah.
And I have very little discretion in that rate sheet. If I call myself a lender, then I get a little bit more discretion over gain on sale, and therefore I can lower.
You control the price, but you also assume the risk.
Sure. So then what does lenders want?
And you can still broker. So the same way you could, right? So you're not. Yeah.
So Lenders One's value, as you guys probably know, is that they is more just the bargaining that they in essence negotiate on behalf of several hundred members in their consolidated production volume. They negotiate bulk deals and discounts that they distribute to their members. They're mortgage community. Did it break up?
Yeah. Yeah, I didn't get much of that,
Did I
but
break
yeah,
up?
I mean, there's any number of things that I know the TMC folks a lot better, and we're a lot more plugged into TMC, but I think it's a lot of the similar ideas, right? Where for all kinds of different things, they have special offers that I actually, you know what? Now that I think about it, more really large organizations should join those because that's when vendors try to lock in the richest organizations to the longest. I don't know Nexus financial position whatsoever, but I'm assuming it's a better one than a lot of companies. Maybe they benefit from.
Well, they don't have any costs. In a lot of them, I don't know about this with Nexia, but I know a lot of these larger organizations, all their LOs are 1099. So they don't have. So the cost of insurance and the cost of 401k, and they don't have all these back office expenses. So as a result, there's more money for them to keep and more money to give to their LOs.
Maybe the more interesting question is like the 20-person brokerage, right? Not the 6,000 person brokerage. Should those guys join? Lenders One?
Join what? No.
But Brock, I'm saying like that implies that Lenders One is doing better negotiating on behalf of their members with vendors than UWM is. And I wonder how that's true. And maybe it is. But
I don't know that's true. I don't know their offers, but
because Lenders One doesn't give me the rate sheet discretion that Rick described. Just being a member of Lenders One doesn't get me that. So if I'm becoming a lender discretion, I still am on a pricing engine, and you're still telling me that pricing engine is cheaper with Lenders One than with UWM, and I'm just surprised by it.
They actually have they have bulk negotiate investor delivery benefits. No, with specific investors, not Fannie and Freddie per se, but with specific investors who are connected with Fannie and Freddie, who then can pass that benefit to the Lenders One member. That's really how they got started. Was outside of bulk discounts on vendor services.
PennyMac gives a shit whether a loan was delivered by a Lenders One lender or not. That can't be true.
It's just because if I'm PennyMac and I'm getting loans from Lenders One members, that's loans that I may not have gotten otherwise.
I guess.
So they'd rather what is their cost of sale? Oh, I know, right? There's a lot. But
I mean, if that's the question, you're implying that if Potter Mortgage goes through Lenders One, I call my AE and I go, give me the Lenders One rate sheet. And if I'm not a member of Lenders One, I call my AE at PennyMac and they're like,
no,
here's your rate sheet. I don't understand.
Lenders One is built for lenders, not brokers. So you wouldn't be calling it an AE.
Well, whoever my aggregator point of contact is, right?
Yeah.
My PennyMac point of contact. PennyMac has salespeople. Like, I'm calling in and saying, like, hey, I want to get signed up with PennyMac. And they're like, do you have a AAA discount? Like my hotel asked me, like, now we're talking about, like, what are we talking about? I don't.
Well, you know what we should do? We should have Justin Damola on, the president of Lenders One. He does a really good job, I think, articulating far better than I do. I think the benefit of Lenders One. I like those guys a lot. And they have a very similar, and I'm not saying you don't. I'm just saying, like, the Mortgage Collaborative and Lenders One, I think they do a good job for the small to mid-size IMB to try to create an economy of scale with vendor pricing, investor delivery.
Okay. I want to be very clear.
It's analogous to your point.
I want to be
analogous to your point. Like these trade groups.
I want to be very clear. I do agree for that profile you just mentioned, but that's not the profile we were talking about.
Right.
Because that profile you just mentioned does not access today UWM and Rocket. They compete with them directly. So I can see Lenders One thinking that they can aggregate enough mid-market retail IMBs to be the size of Rocket and UWM. But what we were talking about was, if I have access to the economies of scale through wholesale, why would I give that up to go over to the lenders? That's all I meant was if you're Norcom Mortgage in central Connecticut and you need Lenders One to get you the size pricing that UWM and Rocket get, I get it. If you are Nexa and you have that already through UWM and Rocket, that's what I was asking. What's the benefit of joining?
There's a lot of there's a lot of complexities there, because if you're connected to Rocket, for instance, and Rocket's going to, in order to receive a lot of those benefits, especially as a larger partner, if you don't give them a certain amount of volume, I mean, they're expecting you to give 50, 60, 70% of their volume. And if you don't do that, they have the control to penalize you in their pricing, right? So,
Mhm.
so that's what I'm talking. The price control is a real pressure when you don't have control of the pricing that your loan officers are selling to the street. There's a real temptation there to say, you know what, it might make sense to diversify this across numerous correspondents as opposed to one wholesale lender or one non-delegated correspondent partner like UWM could be.
Mhm.
Um, or just bring it in house like NFM does, where we control our own risk and we're just going to compete head on with these platforms.
Mhm.
So
So
it's
that's the argument for becoming a lender is essentially
why not the why not
yeah,
both why not both argument? Yeah.
well, and I don't know how to explain it, but it really is a dynamic conversation
Mhm.
as you get larger
Yeah.
around
Better deals when you
what that means to your pricing control. And there's a lot of trade-offs. It's not a very linear. It's not linear. It's not like an if then else kind of statement, because it's just the dynamics are kind of pull you in multiple different directions at once. Because there's no question that
maybe a quarter of
cover
what L1 is pre-negotiated for you is better than you to get, and 3/4 isn't, and that's still worth it. Whatever.
Yeah. I mean, Nexa has a tremendous amount of if you look at this from a lender, like if Rock Mortgage is the number one lender in the country for brokers, and I'm connected to Rocket, the reality is that Rocket has a lot of concentration risk in me, right? So there's not a lot of incentive to some degree to build me up, right? Because then all of a sudden I'm going to try to bully them into better price negotiations that they might want to give me. And the flip side is if I'm giving all my volume to Rocket, then I'm not really. I have concentration risk as a large lender. So if I add another lender or two, then all of a sudden I'm getting a lot of pressure from my keystone partner, as in Rocket, to give them more deals. So it becomes this real delicate relationship driven, tug of war.
Yeah, I think that also kind of plays into just like an inability or a lack of desire to just give the best price and just win the day. Like I think a lot of these large lenders are okay giving away market share at times simply because they don't want necessarily all the attention, but I actually think somebody should. I guess is what I'm getting at. Somebody like Rocket or UWM should just give everybody the best price all the time and see what happens. Like, because I don't think Rocket cares about concentration risk in a large broker. I honestly don't. I think they have a desire to have infrastructure everywhere, meaning every possible digital partnership, every call center LO they've got, every broker they've got, every referral source, real estate agent. So like to me, I know they protect the margin. I know everybody has to protect the margin right now, but I just think there's a huge opportunity to undercut that delicate balance, Rick, that you just mentioned, and just be like, here you go. I'll take it all this month. And somebody from capital markets at Rocket will tell me why they don't do that.
Yeah.
But they could. They could.
That's fascinating. No, I think this will be a fascinating show.
For other people will. Yeah.
Yeah.
I mean, we have seen that before. Like, right? Was that was it 2 years ago? UWM undercut.
Yeah, it was 2 years ago.
A ton. Yeah.
And Rocket had to respond at that point. Yeah.
I would never. That's a whole separate conversation. I would say that, boy, I tell you, I've never seen a more aggressive organization as I've seen in UWM and how they've approached the market. And how aggressive they've gone after. And someone did spill some tea that that the Mr. Cooper deal was actually pitched to UWM first, and they turned it down, which I found that was pretty interesting. That was mentioned on stage actually at the conference last couple of days, and that's a pretty fascinating thing. And what I would say to you is, while it goes through the regulatory process, I'll be curious to see how much of Mr. Cooper's, how much of the portfolio still, because I know that the call center at UWM is going after and picking apart that to try to convert as many of those consumers over to their portfolio before the deal closes. So they're paying $9 billion for what? For a diminished portfolio.
Yeah.
And
I think that's kind of interesting. I mean, I think a couple things. One, I had heard something else surprising too after that deal, because I did not realize, and I'll admit it, I didn't have the information that Mr. Cooper was available. And I was like, oh, wow, Mr. Cooper's available. But somebody told me when I mentioned that, who would know, said, yeah, they were available for years, actually, that Mr. Cooper's been on the market for 4 years. And I didn't realize that. So it's not that it was offered to UWM first. It was just offered, period, for a while. And Rocket just picked the moment. And so I think it's funny because I think UWM has a good strategy around tell DC that these two are too big together and you should be scared of them, while also picking it apart and making it smaller. And on one side of the house, they're like, oh, it's so big, you should reject this. And on the other side of the house, they're like, it's not a big deal, we're just going to pick it apart. So it's like have your cake and eat it too thing.
Well, I mean, that's a time-honored strategy, right? And like M&A and like private equity land of like let your competitors try to do acquisitions that you don't think they'll be able to get done and waste time on them, right?
No, but I'm saying it will get done. They're fake objecting to it as being too large, while at the same time making it smaller and less risky for the market, which is hilarious.
No doubt. Yeah.
And the only other thing I kept coming back to, and I haven't had Varun say this, but I do wonder if there was an element of Sagent versus MSP in this deal, where Rocket is okay getting out of the ICE business and being on Sagent. I don't know, and I have no inside information on that, but like it does sound like they're picking Sagent over MSP, and that would be really fascinating if part of the deal was a calculated risk on what servicing platform I want to be associated with, but I have no idea.
Yeah. Well, we've almost gone a full hour for one of the few times in Real Fridays history. So this has been great. I know, Jeremy, you and I have a call here in a couple of minutes. And I look forward to seeing you guys at the gathering here on Sunday, and also being able to do a live show. Let's do a live show and do a 30-minute at the Broadmoor. I think it'll be extremely well attended. It'll be well to do.
They may even have public Wi-Fi, so people will be able to hear you.
Have a good day.
Yeah, I'm getting in Sunday. I think Rick's getting in even earlier. When are you getting in, Potter?
Monday. I'll see you guys Monday.
All right, we'll do a show Monday afternoon. We'll have maybe we can have some people, if you're listening, let us know, and you can walk through the show, jump on.
Sounds good. Drive safe, Rick. Talk to you soon.
Good
bro.
deal. We'll see you guys later.
Bye.